and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. So we're edging our way towards the end of the year, and we have limited catalysts for any major moves, potentially not. But Jeff published his weekly playbook on Sunday, which is available on Substack at hugeinsights.substack.com. Jeff, welcome back.
Hey, great to be here, Mehdi. Thanks for having me on the show today.
So before we dive right in, don't forget to like and subscribe to Your Finance TV and stay on top of all of our content. But as usual, Jeff, I would like to hand over the microphone to you and kick off with the top down.
Yeah, we saw the S&P 500 break out to a new recovery high. This, has a lot of the bulls really cheering, thinking that this is a major, coup on their part. We don't really see it that way, as I'm sure you can imagine. Last week's performance was something less than epic. I think we were up about 0.25% all in. And so, nothing to really get that excited about. This week, we've got a lot of data. This morning, we had the CPI came in a little bit worse than expected, but the market actually responded favorably to it initially. We'll see how that plays out the rest of the day. We got earnings from, a couple of bellwethers this week. Oracle reported they missed. Stocks not acting well. We have Adobe, we have Costco, which is going to be, I think, a really interesting take on how consumer spending is working. We get the PPI tomorrow, and then, of course, we'll also have Jerome Powell's comments after the FOMC meeting ends. No one is expecting the Fed to make a move. This will be a continued pause. I think the odds and odds makers are suggesting a 99% probability or greater that the Fed holds. It's really going to be, what is Powell's rhetoric? One of the things that we've been thinking about, and we put in our note, was that we thought the market might make one final push higher and potentially attempt to fill a gap, the last open chart gap at S&P 4663. That dates all the way back to January 14th, 2022. So just after the market peaked 10 days later. And so, that's the last gap. There's also the wave 2 high, which is, the March, early April high that came in around 4637. That looks like it's maybe going to get a hit today. I think we were only 14 points below it at last night's close. We kind of pegged that the market's really less than 1% away from, our stretch target of 4663 here. We did change our count to a double zigzag from a zigzag. So the count's now WXY. We'll be putting in primary wave 2. So slightly different. We talked about this a couple of weeks ago about how if the market did make a new high, a new recovery high rather, that would change the count. It's not a big deal. It's semantics, really. Overall, I think that we're looking at a market environment that is losing momentum, where investor sentiment has probably peaked and begun to roll over. And, there's a lot of evidence that would suggest that the market is topping right now. So as opposed to, prepared to blast off, which I think is the bull case. And so, we're playing devil's advocate with our analysis, but, it has to be done. And, we think the evidence is mounting, that the S&P is poised to put in an important top and roll over going into 2024. And with that, we continue to recommend that our readers, subscribers, investors remain patient, minimize net equity exposure, maximize cash reserves, collect your 5.4% on 3-month T-bills, and be happy that you're not long or overexposed the market as things peak and roll over here, as we suspect they will.
So, Jeff, you kick this week off with a look at global debt and also you overlay GDP versus that debt. It's always scary seeing some of these debt figures, but this just doesn't look that rosy.
No, it doesn't. It speaks to the underlying conditions of the global market, right? I think one of the things people are losing sight of is what all of this leverage in the system means from a risk perspective. The Institute of International Finance published this report looking at the first half 2023 debt buildup. This came out in September of 2023. You know, I've read through it a couple times here. I thought about putting it in notes before, but you know, it's really starting to resonate with me more and more as we see global debt exceed the 307 trillion mark. It's a new all-time record extreme, and debt to GDP has pushed back up after receding for 7 consecutive quarters. In the first half, it jumped back up to 336%. That is an incredible amount of leverage in the system. And so when we look at the change that's taken place over just the last decade, we've seen global debt increase by approximately $100 trillion. That's a 50% increase in 10 years. And with the debt to GDP ratio at 336%, you know, we got to be wondering, you know, what is that debt contributing to GDP? Well, you know, not surprisingly, as Reinhart and Rogoff would have predicted based on their research, it is contributing less than you would expect. In other words, every dollar of new debt contributes about 90 cents to GDP. So the debt to GDP impact, this incremental impact of each new dollar of debt is lower than $1. It's negative. And that's the conclusion of Reinhart and Rogoff's research, that once debt to GDP exceeds 90%, you start to get this negative effect from the incremental multiplier effect of debt. And it is turned negative from a global perspective. And this is not good. The other thing that's important about this report is that 80% of that new debt was put on by developed economies. And historically, you know, new debt has been created by emerging economies. They only accounted for about 20% of that debt. Of course, the United States, Japan, the UK, and France are the biggest contributors to that debt from a developed economy perspective. From the emerging economy perspective, not surprisingly, China is at the head of the move, India, and then Brazil. Those are the 3 key contributors. I don't think Russia's been able to issue new debt unless China's buying it. So they're kind of off the map when it comes to it this year. But that's kind of the story with respect to global debt.
So there's been more chatter that the market's broadening. And, you know, I think you're highlighting that this really isn't the case, correct?
It is. It's correct what you're saying. I mean, the market has broadened from its extreme lows. There's no question. Don't get me wrong. We've seen a big uptick in participation off the lows, but we're nowhere near where we need to be in order for this to be a sustained bull market. In other words, you know, I've been reading all over the financial media and on my Twitter feed how this is the broadest move we've seen in the S&P 500, blah, blah, blah. It's just simply not true. I mean, what is true is that we had a big move off the lows and we've broadened out, but only 68% of S&P 500 stocks are currently trading above their S&P or their 200-day moving average. If you look back to, say, 2021, where we actually had a bull market, that level was well in excess of 80%. In fact, we didn't break below the 80% threshold for about a year. Okay, we stayed in the 80 to 95% of issues trading above their 200-day moving average, as you know, following the breakout above the pre-COVID highs, and that, you know, once the market made a new all-time high, we could actually say we're in a bull market, right? Because, you know, one of the key characteristics of a bull market is its ability to consistently produce consecutive new all-time highs, an uptrend with no resistance levels. And so what we're looking at right now is we're looking at a recovery. We believe it's a counter trend advance. It's quite extended, no doubt, right? But it's a choppy, overlapping pattern that's very characteristic of corrective waveforms. We've yet to make a new all-time high. So we're certainly not in a new bull market from that perspective. And the number of stocks in the S&P 500 that are contributing to this is well below what we would expect and what's attended past bull markets. If we look beyond the S&P 500 to, say, the New York Stock Exchange, the numbers are even worse. And if we look at the NASDAQ, they're shockingly poor. And so, if we look at a very broad swath of or participation, it just doesn't exist the way it would be expected to, and has historically, attended past bull markets. So that's really the point.
So volatility, we've talked about this on and off over the last several months, right? It's just been non-existent. Surely at some point things will pick up.
True. And I want to step back to the last chart just to say, I forgot to mention that we had a not joke in the in the title. But no, to your point about volatility, I mean, the VIX got down to 12.35%. That's the lowest that we've seen in kind of this post-COVID regime. That breakdown really looks to us to be representative of a new extreme in investor complacency. And, we think that that is very likely to change as the market reverses course, which we believe it will. Another thing that's starting to show up on our radar screen again is the skew index, which is, a look at how investors' preferences for out of the money puts versus out of the money calls is really the way to think about it. Normal would be a level of 100, okay? But we've gotten up to a level of around 155% on that recently. And that suggests that investors at that point had a much, much stronger preference for out of the money call options than puts. Well, that is sharply lower today. We've gotten down to about 130% on Friday's close. And that suggests that we've seen a dramatic shift away from out of the money call buying toward a, potentially emerging preference of out of the money put buying. Now, what's historically been the case is that the skew index has led the VIX index slightly. And so when, we start to see longer term hedgers coming in saying, we need to start shoring up our more durable hedge position, that should be an indication that things are likely to change. And so, our position is that eventually, ultimately, as we see a durable rollover in the S&P 500, the alligator jaws here in this chart are going to snap shut, where we will see, the skew index move back toward normality at 100 from its current 130% or so, and that we should see the VIX index press up at least to trend resistance, which comes in around the mid 20% range, which would be doubling from where we are today. But I think we'll break through that. I think the next peak in the VIX will be marked by something in the mid to high 40s or even higher. It's been at least 2 years since we've printed a 40% move on the VIX, and I think we're due.
So, Jeff, let's hit some technicals here. Obviously, there's been some changes with the new highs that were established this week. And can we have a look at the primary degree Elliott Wave analysis?
Yeah, so the chart's really depicting the rally off of the October 2022 low. And what we've done is we've changed the count to reflect a double zigzag form. So the first zigzag was basically the move up into the December 1st, the pullback and a rally into the December 13th high. And so that December 13th high marks wave W, which is the end of the first zigzag. Now, the double zigzag is bifurcated by an X wave. So the decline off of that high actually, and I believe, I'm sorry, the actual high was February 2nd. That February 2nd high marked W. The decline off of that level was an X wave. And from that X wave low, which was the March 13th low, we've rallied again in 3 discernible waves. The first was a 5-wave impulse that peaked in July 27th. The pullback, which we are now counting as an ABC, that is pulled back into the October 27th low. That was the B wave of the second zigzag. And we've just are very, very near completing wave C of this second zigzag, which we will mark as Y. So the pattern is now WXY. And we believe that pattern has, as I mentioned in the outset, the potential to move up to somewhere between, say, 46.37, which is the March 29th, 2022 high, or fill the gap that goes back to January 14th, 2022 at about 46.63. Now, I actually don't think that gap's going to get filled. Okay, it doesn't need to be filled. Okay, but it's possible. It's possible that the market will push up that high. But I think that the high is either in today or in tomorrow. And the reason I say that is today is a new moon. New moon is part of Paul McRae Montgomery's work. It's not an actual Montgomery cycle turn date, but it's part of the process. It's part of the lunar cycle. And oftentimes we do get a delayed reaction from prior cycle highs. And the most recent one we had was the November 27th. And so this could be what he would have called the echo effect. And what's interesting is we've got, December 13th, which happens to line up with a Fed decision day, a Fed report day. And that actually is a key date. If you look back, going all the way back to the October 13th low in 2022, 13 is just a number that keeps showing up. We had December 13th, we had March 13th. It's a high probability that December 13th could be the number. If it's not December 13th that marks the high, then it would be December 27th. We had July 27th, we had October 27th. And again, December 27th would be the next full moon, plus or minus a day. And so again, part of that lunar cycle. And I would suggest that, regardless of which day it is, and I think it's probably going to be the 13th, I think the next important move is to the downside. And why do I say that? Because once we complete this double zigzag pattern, once it terminates, that will mark the end of primary wave 2 up, which is a counter trend advance of a 5-wave impulse to the downside. The wave that follows primary wave 2 is primary wave 3 down. Primary wave 3 down will be the most powerful, the most dynamic wave within that 5-wave impulse sequence. And we expect it to carry prices down as low as, say, S&P 3000 to potentially S&P 2700. But I think, we've actually elevated our target just because as the markets moved up, the Fibonacci measure from this new high is going to be slightly higher. And so, we're going to use a round number of, say, S&P 3000. We think that's a reasonable level for wave 3 to bottom. If we're wrong about that, it'll probably be 10% lower.
So, Jeff, how do market internals look at this point?
They've recovered substantially, okay? And so a lot of people would look at that and say, hey, market internals look really, really strong. The problem is they're less strong than they were at the prior highs, okay? And so that constitutes a negative divergence, okay? We're seeing that in breadth, okay? Breadth last week was about 20% of S&P stocks were advancing. That's down from 52% in the prior week, okay? So that's actually contracting breadth. If we look at the 5-week moving average of breadth, it's fallen short of its prior high. And so this suggests that breadth is not strong within the S&P 500 as it was in, leading into this counter trend advance. If we take a look at momentum, there's a lot of evidence developing that momentum is starting to fade. Momentum is deteriorating. It's slowing. And if we take a look at where we are, yes, we're in overbought territory according to the 5-week RSI oscillator, but much lower high than we saw at the July peak and the peak prior to that. And so, this suggests that we've got a negative divergence in momentum. If we take a look at net advancing volume is basically been flat. And the 5-week moving average is kind of hovering around the, say, 3.25 to 3.5 range. That's not indicative of a powerful bull market advance. Normally, just a stable advance would be about 5 to 1. A powerful bull market advance would be 7 to 9 to 1, in that kind of 7 to 9 range. And so we're just not seeing that whatsoever. And in fact, if we take a look back at where the net advancing volume 5-week moving average was, at the kickoff of this bear market rally, as we'll call it, it was substantially higher, and so we're just not seeing the same degree of enthusiasm in terms of action in the market. And so that being said, enthusiasm from a psychology perspective is quite high.
And is that enthusiasm continuing through on the investor sentiment side?
It is. We're looking at both the name exposure index to kind of gauge a sense of where the pros are positioned, and then also the American Association of Individual Investors weekly survey to get a sense of where retail investors are. But there are some anecdotal pieces of evidence too that I'd highlight. Take a look at Bitcoin. Bitcoin's had a huge move to almost 45,000 in recent weeks, only to be quashed by a few words that came out of a particular senator's mouth over the weekend, who has been a vocal dissenter with respect to the importance of Bitcoin, and suggesting that and I think also we've heard some recent commentary from key business leaders, Jamie Dimon among them, who has been, again, another vocal dissenter with respect to the case for Bitcoin, but highlighting the fact that Bitcoin has really got, only three use cases: crime, tax avoidance, and I forget what the third one was, but whatever it is, it's not good. And at the end of the day, I mean, when you see basically people buying tulip bulbs, okay, they're buying Bitcoin, which has no real use case other than it's got a limited supply. It's a hiding place more or less, but it's also a speculative move, and so we're seeing this speculation brewing up. But again, with respect to the surveys, we're seeing that speculation build up as well. Recent name exposure levels, got up to around 80% or so. We've pulled back now to around 76% from that high. So it looks to me like that professional positioning has peaked and is beginning to roll over. It's also showing up in the AAII bull bear spread, which peaked at around 29.5% a couple of weeks ago. We've now pulled back 9 percentage points to 19.9% as of this week. And what's changed? Well, the bulls, those people kind of orienting themselves as bulls, has pulled back a little bit, but more people are getting bearish now. And why is that happening? Because, well, we're reaching a new extreme, reaching extreme valuations, we're reaching extreme in sentiment, and people are watching this. I'm not the only person that has access to this information, and so people are reacting to that move, and it's showing up in the numbers. And this usually precedes a trend reversal. And so, what I'm basically trying to say, based on all the evidence that we presented here, is this tends to be the condition that exists before a major trend reversal. And so the setup is in strong support of a top in S&P prices and a reversal going into next year.
So, Jeff, obviously much of this rally or the strength in this market has been attributed to seven stocks, Coin, the Magnificent Seven. How have they been holding up?
Well, they have been leading, no question about it. And, we've looked at, all sorts of performance metrics off of this October low. And, it's not, not unknown that small caps have had a big move, a much bigger move than even the mega caps have. Some small cap indices are up as much as, say, 15% off the low. That's what you would expect. Okay, things that are down, 33%, they rally more strongly in percentage terms off the lows. But the thing that is not being reported on in these performance numbers is that we're nowhere near breaking out to new highs in these indexes. They're bouncing off really, really low lows. So I would call it a dead cat bounce. What we're really seeing is the leadership stocks continuing to carry the ball. Stocks like Amazon and Google and Tesla and Meta and Nvidia, those stocks have done very, very well. Apple, of course. Microsoft actually slipped a little bit last week. It was the only Magnificent Seven stock not to post a gain last week. Google posted around a 2+% gain based on the release of their Gemini product, but then it was also, I guess, reported on over the weekend that they falsified the presentation of that, and so the stock sold off. I mean, it speaks to the hype that's built around this whole AI phenomenon, right? Whether or not it turns out to be the next great thing remains to be seen. We're in such an early stage of this. I have no doubt that 20 years from now, AI is going to be an important part of our everyone's technology, function, right? But today, it's really just too early to call who the winners are going to be, and anything that's associated with AI seems to get a bid right now, but that bid is not as strong as it was. Okay. And it's becoming a little bit more discerning. And I think importantly, if you take a look at the valuations on these 7 stocks, they are again hovering at nosebleed levels, nearly 32 times forward 12-month earnings expectations on a weighted average basis. Some are better than others. Some are worse than others. I think if you take a look at the price to sales metric, which is a very transparent view of what's happening here, this group trades at 10 times forward or 10 times sales. And so from a standpoint of valuation, it's just radically overvalued relative to the broad market. And so, the question is, does the growth support that? And 5-year forward growth estimates are around 15% for these 7 stocks on average versus 9% for the S&P. Honestly, I think the growth rate for the S&P is too high. And so therefore the growth rate on these stocks is probably too high as well. So I do think that they're overvalued. I don't even think it's showing up the extent to which they're overvalued. If you use like a peg rate to look at it, those who are looking at the peg rate might be like, hey, probably should be trading at 3.5 times forward growth if the S&P is trading at 2.2 times. But the bottom line is the S&P is overvalued too. And so these stocks are extremely overvalued. And therefore, I think that they have an extreme amount of risk associated with them. So if you're overweight these stocks, you almost can't help being overweight because they account for nearly 30% of the S&P 500 index and 60% of the NASDAQ 100 index. And, under that particular rubric, you are highly concentrated in a group of the most overvalued, riskiest stocks on the planet, in my opinion.
Jeff, let's wrap. Following on from that, let's wrap with some sectors that you do like, and especially from a valuation analysis as well as from a sector relative strength analysis.
Yeah, what do I like? Well, the areas within the market that look cheap to me would be energy. So from a valuation perspective, energy has the highest cash flow yield right now, free cash flow yield. It has the lowest PE on current and forward earnings of any sector. I think that there's a supply-demand imbalance that should continue to support that free cash flow yield and possibly even grow it. We're seeing, none other than Warren Buffett aggressively invest in energy with his positions in Occidental Petroleum, which also made an acquisition of $12 billion of another E&P company. And then, of course, he has a big position in Chevron. And so, it does not surprise me that, a wise, sage investor such as Warren Buffett would be taking advantage of this cheap valuation in energy. What looks expensive is technology across the board. It is trading at a 50% premium to the market, energy trading at a 50% discount. And so, when we look at these two sectors, well, someone in the marketplace is wrong here. And I suspect it's those investors that are crowding into these popular stocks that have elevated the valuation of technology to this extreme. So what do I like? Well, from a relative strength perspective, you can't argue against tech. It is the relative strength leader right now, but that can change, and it can change quickly, especially when it's kind of isolated by itself. And we've already seen that change start to develop in its partners, right? It was the three musketeers: tech, comm, and discretionary. Well, most recently, comm has reversed and seen a very strong momentous reversal in its relative strength. And that follows discretionary, which has been, now in the lagging quadrant for a number of weeks. What's improving? Well, we've seen big improvement in financials recently, so we can't discount that. REITs have improved dramatically. Staples, utilities, not on an absolute basis, but on a relative strength basis, we've seen dramatic improvement in those four. And so, I would start to kind of shift toward defensives. I continue to like energy from a valuation perspective, but from a relative strength perspective, I think these defensive categories like utilities, staples, REITs to a lesser extent, financials certainly have, a valuation sort of based bid underneath them right now. Perhaps we could see that extend a little bit. And I wouldn't rule out healthcare. In fact, if we took a look at earnings and just from a sector perspective, where are the biggest earnings growth for 2024? It's actually healthcare. Healthcare has analysts are expecting the biggest year-over-year growth in earnings from healthcare, and so I wouldn't rule it out. It would definitely be on my monitor for improvement going forward, but I'd stick with defensives for now.
Perfect. Thank you, Jeff. I really appreciate you sharing your thoughts from Alpha Insights.
Always a pleasure.
And I want to urge our viewers, make sure you check out Jeff's content on Substack at hugeinsights.substack.com. And of course, Jeff always has his top actionable trade ideas within there. So, sign up and check those out because they're always a great way to kind of position your portfolio. But thanks again and good luck investing.